There is a conversation happening at every family dinner in America right now. Someone asks when you are going to buy a house. Maybe it is your parents, maybe it is your in-laws, maybe it is a coworker who just closed on a place and cannot stop talking about it. And the message underneath every version of that conversation is the same. Buying a house is what responsible adults do. Renting is throwing money away. Real estate always goes up. This is how you build wealth in America. I am going to show you the math behind that belief, and I am going to show you exactly when it is true, exactly when it is not, and the specific number that tells you which situation you are actually in, because the honest answer is not what either side of this argument wants to hear. My name is Dantic. I spend an uncomfortable amount of time with financial data, real numbers, and the gap between what people believe about money and what the math actually shows. If you want honest financial education with no agenda and no product to sell you, subscribe, because today we are doing the math on the biggest financial decision most Americans will ever make. And I will warn you now, if you already own a home, some of this is going to be uncomfortable. If you are renting and feeling behind, some of this is going to be a relief. And if you are trying to decide right now, this video might be the most useful 16 minutes you spend this year. Let us start with the belief. The idea that buying a home is always the right financial move is not random. It has roots, real roots. In 1950, the median American home cost roughly $7,400. By 2000, that same type of home cost around $119,000. By 2024, the median home sale price in the United States crossed $420,000. If your grandparents bought a home in 1970 for $23,000, and it is worth $380,000 today. Of course, they believe real estate is the greatest investment in human history. Their lived experience confirms it completely. The problem is their experience was shaped by a set of conditions that no longer exist in the same form. Interest rates in the 1970s and 80s were brutal, sometimes above 18%, and then spent 4 decades falling. Falling rates make existing home values rise. The boomers did not just benefit from appreciating real estate. They rode the longest declining interest rate environment in modern history. When rates fall, home prices rise almost automatically. The math demands it. In 2022 and 2023, rates did something they had not done in 40 years. They rose sharply. The 30-year fixed mortgage rate went from roughly 3% in early 2022 to above 7% by late 2023. By 2026, rates have remained elevated, and the math of what that does to your monthly payment is something most people have never actually calculated. Here's the number. In January 2021, the median home in America cost around $300,000. At a 3% mortgage rate on a $240,000 loan after a 20% down payment, your monthly principal and interest payment was approximately $1,012 per month. That same $300,000 home today, after price appreciation, costs closer to $420,000. At a 7% mortgage rate on a $336,000 loan after 20% down, your monthly principal and interest payment is approximately $2,236 per month. Same type of home, same American dream. Monthly payment more than doubled, and that is before property taxes, homeowners insurance, HOA fees if applicable, and maintenance. The total true cost of homeownership is something almost nobody calculates before they sign. Let me give you the real number that changes everything. Financial experts call it the price-to-rent ratio. It is one of the most important numbers in personal finance that almost nobody talks about at dinner parties. Here is how it works. Take the price of a home you are considering buying. Divide it by the annual rent you would pay for a comparable property. The number you get tells you whether buying or renting is the mathematically smarter move in that specific market right now. If the ratio is below 15, buying typically wins financially. Between 15 and 20, it depends on your specific situation and how long you plan to stay. Above 20, renting and investing, the difference typically produces more wealth over time. Right now in 2026, the national median price to rent ratio in the United States sits at approximately 26. San Francisco above 40, New York City above 35, Austin, Texas above 28, Nashville above 25. Even markets that used to be affordable have ratios well above the 20 threshold. What does a ratio of 26 actually mean in plain language? It means that in the average American market right now, a renter who invests the difference between what they would have spent on home ownership and what they actually spend on rent, if they do that consistently, will likely come out ahead financially over a 10 to 15 year period compared to the buyer. Not because buying is bad, because the ratio is high enough that the math currently favors renting and investing in most major American markets. This is not a permanent truth, it is a present truth. Ratios change, they have been lower in the past, and they will likely be lower in the future. But right now, in 2026, in most American cities, the math of homeownership is different from what your parents experience. Now here is where the conversation gets genuinely uncomfortable, even for people who already own. There is a number called the true cost of homeownership that almost nobody calculates before they buy. Let me walk you through what it actually looks like on a median American home purchased in 2026. Purchase price, $420,000. Down payment at 20%, $84,000. Loan amount, $336,000. Monthly principal and interest at 7%, $2,236. Monthly property taxes, national average, approximately 1.1% annually. $385. Homeowner's insurance average, $150. Maintenance, and this is the number people always underestimate. Financial planners recommend budgeting 1% to 2% of home value per year. On a $420,000 home, that is $350 to $700 per month, we will use the conservative $350. Total monthly cost of ownership, approximately $3,121 before any HOA fee on a $420,000 home per month. Now compare. The median rent for a comparable property in the same market, approximately $2,100 per month nationally. The monthly difference, $1,021 every month. That $1,021 represents money that a renter has available that a buyer does not. The question is not whether buying costs more than renting right now. It does in most markets. The question is what happens to that difference. If the renter puts that $1,021 into a diversified index fund every single month and earns a 7% average annual return, here's what happens over 15 years. The renter accumulates approximately $321,000 in invested assets. Plus they kept their $84,000 down payment invested. That $84,000 at 7% over 15 years becomes approximately $231,000. Combined, roughly $552,000 in liquid invested asset. The buyer over the same 15 years has built equity in the home at a national average appreciation rate of approximately 4% per year, which is generous given current market conditions. The $420,000 home is worth approximately $756,000 after 15 years, minus the remaining mortgage balance of roughly $258,000. The buyer's equity is approximately $498,000. The renter came out slightly ahead in pure net worth terms, $552,000 versus $498,000. And the renter's assets are completely liquid. The buyer's wealth is locked inside a house they still have to live in. This math is not designed to make you sell your house. It is designed to show you that the choice between renting and buying is not as obvious as the dinner party conversation suggests. The numbers are closer than most people realize. But here's where it gets more nuanced, because I promised you the honest math, and the honest math cuts both ways. There are specific situations where buying makes overwhelming mathematical sense, and if you are in one of them, renting is likely the wrong choice for you right now. If you are planning to stay in one place for 7 years or more, buying starts to overcome its high upfront costs through equity building and mortgage paydown. The break-even point in most markets is currently between 5 and 8 years. If you are staying that long, the math shifts in buying's favor. If you have a fixed rate mortgage locked at 3% to 4% from before 2022, and you are sitting on it, your cost of ownership calculation is completely different from someone buying today. You are in an objectively strong financial position relative to both current buyers and renters in your market. Staying put and not refinancing unless rates drop significantly is almost certainly the right move. If you are buying in a market with a price-to-rent ratio below 15, and they still exist in parts of the Midwest and South, buying is the mathematically stronger choice right now. Birmingham, Alabama, Memphis, Tennessee, Cleveland, Ohio, St. Louis, Missouri. These markets still have ratios where buying outperforms renting by a meaningful margin, and there is a non-financial calculation that the math cannot fully capture: stability. The ability to renovate a space to match your life, not having a landlord who can decide not to renew your lease. The psychological value of a place that is yours. These things are real. They are not irrational. They belong in the calculation. What is irrational is buying a home primarily as an investment in a market with a ratio above 25 without doing this specific math first. So here's the framework. The 3 questions that determine whether buying or renting is the smarter financial move for you specifically right now. Question 1, what is the price to rent ratio in your specific market? Not the national average. Your city, your neighborhood, you can calculate this yourself. Find the sale price of a home you would buy. Find the annual rent for a comparable home. Divide. If the answer is below 15, buying is likely the stronger financial choice. If it is above 20, renting and investing, the difference is likely the stronger choice given current conditions. Question 2, how long are you planning to stay? If the answer is less than 5 years, the transaction costs of buying, closing costs, agent fees, moving costs almost certainly outweigh any appreciation or equity you will build. Renting wins at short time horizons in almost every scenario, regardless of the ratio. Question 3, what will you actually do with the difference? This is the question that almost never gets asked. If you are renting a place for $2,100, that would cost $3,100 to own. That $1,000 per month difference is the entire argument for renting, but only if it gets invested. If it gets spent on lifestyle, on dining out, on the things that lifestyle inflation quietly consumes, then the financial argument for renting collapses entirely. The renter who does not invest the difference does not build the wealth that the math promises. The math requires the discipline. Let me tell you what the honest summary looks like in 2026. Buying a house is not making people poor because houses are bad assets. It is making some people poor because they are buying houses in the wrong market at the wrong time, with the wrong timeline, and without calculating the true cost. The purchase decision is being driven by social pressure, by the fear of missing out, by the belief that renting is throwing money away, when in many current American markets, the math says the opposite. Renting is not throwing money away. Paying for shelter is not throwing money away. Paying $2,100 per month in rent so you can invest $1,000 per month into an index fund while maintaining the flexibility to move for a better job or a lower cost of living market. That is a financially coherent strategy in 2026 that the dinner party conversation completely ignores. And buying is not wrong. In the right market, with the right timeline, with a rate you can genuinely afford, with the realistic intention of staying for 7 or more years, buying is still one of the most powerful wealth building tools tools available to American families. The equity builds, the mortgage pays down, inflation erodes the real value of your fixed monthly payment over time. These things are all real. The error is not in buying or renting. The error is in making a $420,000 decision without doing the math. Calculate the price to rent ratio in your market. Honestly assess your timeline and decide what you will actually do with the difference if you rent. Those three questions, answered honestly, will give you a better answer than any dinner party conversation ever will. Do the math before someone else's belief system makes a $420,000 decision for you. One last thing, and I mean this, I am not a financial advisor. Nothing in this video is personalized financial advice. Everything you heard today is based on publicly available data, historical averages, and mathematical frameworks that you can verify yourself. Real estate markets vary significantly by location and timing. Your specific situation, your income, your timeline, your local market, your risk tolerance, requires a qualified professional who knows your full picture. Take what is useful from this video, verify anything that matters, and make your own decision with your own eyes open. If this changed how you think about the biggest purchase of your life, drop a comment telling me whether you are a buyer, a renter, or still deciding. I read every single one. And if you want to understand exactly how to invest the difference instead of spending it, that video is right on your screen. Go watch that one next.